Welcome to the Research Desk. Today we are beginning episode 1 of our Gravity and Fuel series. And the central tension we are exploring, it addresses a really terrifying paradox that challenges the very foundation of financial analysis.
Terrifying is definitely the right word for it, because we are looking at why the smartest investors in the world, people who possess immaculate pedigrees, who have endless capital, who build flawless mathematical models, and who are completely verifiably right about the empirical facts, why do they still manage to lose absolute fortunes in the market?
Exactly. I mean, if you are listening to this and looking at your own portfolio, you have probably experienced the profound frustration of making a perfectly rational investment thesis, watching the data prove you completely correct, and still suffering a massive drawdown. It makes absolutely no sense until you understand the underlying mechanics.
Right. And my position here is that the fatal flaw in modern investing is not ignorance. It is compartmentalization. The prevailing culture of financial analysis trains brilliant minds to master a single analytical tradition.
You are taught to be a fundamental valuation purist or, a quantitative momentum trader or a macroeconomic regime forecaster. But relying on a single tool is profoundly dangerous because it blinds you to the forces operating just outside your chosen framework.
So I propose that by layering 6 specific analytical traditions through a strict hierarchy of overrides, investors can systematically filter out market noise, identify hidden structural vulnerabilities, and actually avoid catastrophic losses. You do not just need the correct data, you need an integrated intellectual architecture. You have to actively force conflicting models to correct each other's inherent blind spots.
Well, I approach this from a fundamentally different perspective. I certainly agree that single-tool reliance is the architecture of financial ruin. We have seen that play out way too many times. But the premise that you can perfectly insulate yourself through layered integration, I think that is a dangerous mirage born entirely of hindsight bias.
A mirage? You do not think systematic integration provides a structural defense?
Not an absolute one, no. You present this hierarchy of overrides as if markets are deterministic machines that can be perfectly mapped if you simply look through enough lenses simultaneously. But they are not. The concepts of Shannon Entropy and the sudden emergence of exogenous shocks, things we observe through hidden Markov regimes, prove that markets are fundamentally, irreducibly chaotic at their core.
I mean, perfect integration assumes that the information required to make a rational decision is actually present within the financial system, but often the market itself completely decouples from reality.
Exactly. The data you are integrating just becomes a closed loop of fiction. You can build the most sophisticated, mathematically elegant survival suit in the world, but it will not matter for a single second if the atmosphere suddenly vanishes.
Well, we will test that exact architectural disagreement today. To really understand the stakes of this tension, we must return to a specific moment in financial history that serves as the ultimate emotional and analytical anchor for this problem. I want to paint a very precise picture of Cisco systems in March of the year 2000.
Ah, the absolute zenith of the dot-com bubble.
Right, but it is crucial to understand that Cisco was not a speculative fraud. This was not a shell company with a .com attached to its name, operating out of a garage with zero business model. They were the undisputed, indispensable backbone of the internet.
They literally built the physical infrastructure. Their physical routers and switches sat inside every single data center that mattered globally.
Yes, they were laying the literal foundation for the digital future. And their customers were the wealthiest telecom and technology firms on the planet, all engaged in this historic multi-billion-dollar arms race to build out network capacity.
Wait, Cisco had $18.9 billion in real revenue, up 55% from the previous year. They had a fortress balance sheet, real profits, and the stock still lost 89%?
So what actually happened? Think about this for a second.
I mean, the magnitude of that destruction, given the underlying reality of the business, is staggering. It completely defies common sense.
Let us walk through the scoreboard of how traditional analytical tools viewed Cisco in March 2000, because this is where the paradox crystallizes. Every single tool was entirely correct in its isolated assessment.
If you were a fundamental valuation analyst, you built your discounted cash flow models. You looked at the cash flows. You saw the staggering 55% revenue growth. You saw the fortress balance sheet.
And you concluded that while the premium was exceptionally high, it was completely justified because this company was monopolizing the infrastructure of a new global economic paradigm. And you were correct. The growth was real. Cisco did become the dominant force.
Right, and what if you were a quantitative momentum trader? You evaluated a stock that was up nearly 1,000% over a 5-year period. You looked at your moving averages and relative strength indicators, and you saw a textbook technical uptrend with perfect support.
Which means you were correct to ride that momentum. The trend was statistically flawless. And if you were analyzing sentiment and narrative, you saw universal, unbroken agreement among institutional investors, retail day traders, and the financial press.
The story was that Cisco was the most important company in human history. You were correct about the narrative. It was absolute.
And finally, if you were a macro statistician looking at regime models, you observed a persistent, visible, high-growth bull state. Interest rates and capital flows supported expansion with absolutely no statistical indicators of an impending breakdown.
You were correct about the regime. So every distinct analytical silo functioned perfectly. The analysts were not stupid. The models did exactly what they were mathematically designed to do.
Which brings us to the core paradox that must be answered. If every individual piece of the analytical puzzle is factually correct, how can the holistic outcome be the evaporation of 89% of your capital?
Well, the failure lies in the one missing layer that none of those traditional tools are designed to measure. And this is the concept of Shannon Entropy.
Right. Claude Shannon, he developed information theory in 1948 while working at Bell Labs. He was actually trying to figure out how to measure the quality and diversity of signals transmitting through a telecommunications network.
Exactly. And when we lift Shannon Entropy out of telecommunications and apply it to financial markets, we are measuring the diversity of thought and the dispersion of belief among market participants.
Imagine a biological ecosystem like a vast forest. If that forest is filled with hundreds of different species of trees, plants, and fungi, it has high entropy. It is robust. A disease might wipe out the oak trees, but the pine and birch survive, keeping the ecosystem alive.
But low entropy is a commercial tree farm where every single tree is the exact same genetic clone of a single pine. It looks incredibly strong and uniform, but a single specific beetle can wipe out the entire forest overnight. There is no genetic diversity to act as a firebreak.
In March 2000, the information environment surrounding Cisco had become that cloned pine forest. It had completely compressed. When every single analyst is universally bullish, when the narrative is entirely uniform and devoid of skepticism, entropy falls to zero.
There is no longer any diverse information being processed by the market. The system becomes structurally brittle. When the environment is that compressed, it means every available dollar that could possibly buy into the narrative has already bought in.
Right. There is no marginal buyer left. So the instant the fundamental reality even slightly decelerates, the lack of dissent translates to a complete lack of liquidity, and the stock price simply collapses under its own weight.
That structural brittleness is exactly why Cisco is not an anomaly. It is a recurring symptom of a much broader disease in financial analysis. The tragedy of March 2000 was that analysts possessed all the facts, but lacked the intellectual architecture to see how those facts were colliding.
They did not understand that high momentum combined with zero entropy creates a terminal velocity event. Which brings us directly to the necessity of deconstructing the 6 specific blind spots that consistently trap single tool thinkers.
These are the explicit failure modes of the greatest traditions in financial theory, and we should look first at the narrative cycle, or the danger of reflexive belief. This was pioneered by Robert Shiller in his 2019 thesis on narrative economics and George Soros's 1987 concept of reflexivity.
The core mechanism here is that stories do not merely describe market conditions. They actively dictate price. Think of reflexivity like a mirror that actually changes the object it is reflecting.
A compelling narrative actively alters the fundamentals of the company it describes. If the market believes a company is the future, they bid up the stock price.
And that elevated stock price lowers the company's cost of capital, allowing them to issue cheap equity to fund real-world expansion, build actual factories, and hire actual engineers. The belief creates the reality.
That mechanism of reflexive funding is incredibly powerful. But the profound blind spot of narrative analysis is that narratives inherently lack hard price limits. The danger of reflexive belief is that human psychology simply does not operate on a discounted cash flow spreadsheet.
When a narrative takes hold, it scales geometrically in the human mind. We saw the purest modern manifestation of this psychological trap with Peloton between 2020 and 2021.
Oh, the Peloton story was entirely intoxicating to the market. The narrative dictated that the pandemic had permanently altered human behavior, that traditional gyms were forever obsolete, and that home fitness ecosystems driven by recurring subscription revenue were the permanent future of health.
Every single analyst repeated the exact same justification, and the narrative was constantly reinforced by celebrity endorsements, viral social media trends, and a completely captive global audience physically locked in their homes.
The narrative was so overwhelming that it triggered that exact reflexive loop we just discussed. Peloton raised immense capital, aggressively expanded their supply chain, and dominated market share entirely because the narrative provided them with infinite financial fuel.
But this exposes the failure mode of the pure narrative investor. This story told investors exactly why the company was culturally important, but the narrative possessed absolutely no mathematical mechanism to determine what the company was actually worth in dollars and cents.
When belief becomes absolutely universal, it completely detaches from the gravity of financial reality, the fundamental constraint of the total addressable market. Just the simple reality of how many human beings actually want to ride a stationary bike in their living room was entirely ignored.
And when the lockdowns inevitably ended and human behavior reverted to its historical mean, the narrative did not just weaken. It shattered instantly. The stock fell 96% from its peak.
Which proves that while understanding the narrative cycle is essential for capturing upside momentum, relying on it without a structural tether leads to absolute obliteration. The story was powerful, but when it became the only metric the market cared about, it transformed from a growth catalyst into a psychological prison.
Well, if narratives are the rocket fuel that propels markets into the stratosphere, fundamental valuation is the gravity that eventually pulls them back to reality. And here we look to the frameworks established by Aswath Damodaran in 2012.
The underlying mathematical logic of fundamental valuation is unassailable over a long enough time horizon. Eventually, a financial asset must be priced according to the present value of the actual cash flows it will generate.
Valuation anchors serve as the critical reality check. They are the mathematics that prevent you from buying a stationary bike company at a valuation larger than major global automakers.
I understand the mathematical purity of fundamental valuation, but its blind spot is arguably the most frustrating trap for the highly intellectual investor. The severe limitation is that fundamental valuation is completely, utterly useless as a timing mechanism. Fundamentals do not govern time.
That is very true. A stock can float in the stratosphere completely untethered from its intrinsic worth for years.
Returning to our emotional anchor of Cisco, a price-to-earnings ratio of 200 times earnings was mathematically absurd by any fundamental metric in 1998. But if you were a strict value investor who shorted Cisco based purely on that fundamental absurdity in 1998, you were rendered personally insolvent long before the market proved you correct in 2001.
Markets possess the agonizing capacity to remain irrational far longer than a fundamentalist can remain liquid. We also see the inverse of this failure mode. Consider Meta in the year 2022.
Yes, if you applied a strict fundamental valuation framework, Meta was printing massive free cash flow, possessed a fortress balance sheet, and traded at a historically compressed multiple. The fundamentals were screaming that the stock was severely undervalued.
And the statistical regime models also indicated it was a highly stable underlying business. But the sentiment, the narrative cycle, was vehemently opposed to the company due to widespread concerns over massive capital expenditure in virtual reality and detrimental changes to mobile advertising tracking.
Fundamental analysts who bought early based purely on the spreadsheet endured brutal drawdowns because they failed to respect the power of a negative narrative. Eventually, the gravity of reality prevailed, and the stock surged 400% from its trough.
But the single-tool fundamentalist suffered immense psychological and financial pain because they naively believed the spreadsheet would instantly dictate the stock price.
You are assuming that fundamentals eventually catch up to narratives. But what happens when the sheer speed of the price movement structurally breaks the market before fundamentals even matter? We must draw on Benoit Mandelbrot's 1997 work on fractal markets.
Standard financial models assume that prices move in smooth, continuous, normally distributed patterns. Mandelbrot demonstrated that markets are actually turbulent and fractal. Price does not just move smoothly from point A to point B, it accelerates.
The mechanism of momentum is critical to define here. Investors utilizing moving averages and trend-following algorithms buy into an asset simply because the asset is rising. This creates a mechanical feedback loop where velocity breeds further velocity.
But the blind spot is the failure to distinguish between healthy, sustainable momentum and geometric fragility. Think about a stock going parabolic like a rocket fighting gravity. At $10 a share, you only need a few $1 million of new buying pressure to push the price higher.
But when the price hits $150 a share, the market capitalization has expanded massively. You do not just need more buyers. You need an exponentially larger influx of billions of dollars every single day just to keep the price from falling.
Right. And when a price trajectory transitions from a linear ascent to a vertical parabolic spike, the internal architecture of that market becomes profoundly unstable. It is the mathematical definition of a tipping point.
When an asset goes parabolic, the participant base fundamentally shifts. The long-term fundamental accumulators sell out, and they are replaced entirely by short-term, highly leveraged speculative traders.
Because the asset requires that exponentially larger influx of new capital just to maintain its current altitude, the slightest deceleration in that capital inflow triggers an immediate cascading liquidation.
The single-tool momentum trader is completely blind to this internal transition. They see the steepening curve on their chart as a confirmation of their genius thesis, rather than recognizing it as a glaring warning sign that the system has become critically fragile.
And the failure to detect those underlying systemic shifts is the exact trap of the fourth tradition. Hidden Markov regimes. James Hamilton introduced regime-switching models in 1989, and it completely transformed how we should process financial data.
Most investors evaluate a market based on point-in-time metrics. They look at the current volatility, the current interest rate, the current correlation between assets, and they draw a straight line extrapolating that present reality infinitely into the future.
Which is a catastrophic error because markets are non-stationary systems. They do not evolve smoothly. They violently transition between distinctly different statistical states or regimes.
Think of it like the phase transition of water. Water behaves predictably as a liquid, but the exact moment the temperature drops below freezing, it instantly becomes a solid. The physical rules governing the environment completely change.
Exactly. You have periods of low volatility and steady growth. And suddenly you transition into a regime of extreme volatility and capital preservation. The danger of the invisible state is that statistical models are inherently backward-looking. They are entirely trained on the data of the past.
If you are operating in a persistent bull state, your models will mathematically assume that dips are buying opportunities and that high leverage is safe. But a hidden Markov model reveals that the exact moment a regime breaks, all the historical rules change instantly.
The single-tool statistician is completely blind to the phase transition until they've already suffered massive losses. And the concept of shifting correlations during a phase transition perfectly introduces the fifth blind spot, factor decomposition and the mirage of diversification.
Eugene Pharma and Kenneth French revolutionized portfolio theory in 1993 by proving that returns are driven by specific underlying factors, such as market risk, company size, and value versus growth.
Institutional investors universally adopted this framework to build portfolios that were theoretically insulated from idiosyncratic shocks. They believed they could quantify and diversify their exposure across these various independent factors.
If you want to see the fatal flaw of factor decomposition mechanically destroy capital, just look at the global financial crisis between 2007 and 2009.
the entire global financial apparatus assumed that mortgage-backed securities were adequately diversified.
Right. The mathematical models evaluated the collateralized debt obligations and concluded that because the underlying mortgages were geographically distributed across different states, like Florida, Nevada, California, and because they were sliced into different risk tranches, the composite asset was statistically safe.
The risk factors appeared completely independent on the spreadsheet. A default in Miami theoretically had no correlation to a default in Las Vegas. The blind spot was the naive assumption that the mathematical relationships between those geographic factors were stable.
The models failed entirely to account for the underlying regime. The entire edifice of that multi-trillion-dollar diversification relied on one continuous unbroken state, the premise that national housing prices would either remain stable or appreciate.
When that underlying regime flipped, when housing prices began to systematically decline on a national level, the geographic diversification instantly became irrelevant. All correlations went to exactly 1.0. Every single asset class tied to the housing market collapsed simultaneously.
The quantitative models decompose the risk perfectly on paper, but they completely miss the singular, massive macroeconomic variable that linked all those fragmented risks together.
Diversification in that moment was exposed as an absolute mirage.
Which forces us to look at the final and perhaps most profound blind spot. We return to Claude Shannon and his 1948 formulation of information theory. The concept of Shannon entropy is the ultimate arbiter of market health. Markets are fundamentally massive, distributed information processing machines. When you have a diverse array of market participants, some looking at fundamental value, some looking at momentum, some hedging macroeconomic risk, the information environment is rich.
It has high entropy. Prices accurately reflect a wide, complex spectrum of competing views. But when that environment compresses, when a singular narrative overwhelms all other analytical inputs, entropy collapses.
If every single participant agrees on the exact same outcome, the market ceases to process new information. It simply becomes an echo chamber of reflexive validation. We saw this with Cisco. The low entropy meant extreme fragility because there were no dissenting participants left to absorb the shock of negative news.
By mapping these 6 analytical traditions, narrative, fundamentals, geometric dynamics, Markov regimes, factor decomposition, and Shannon entropy, you possess a complete map of the financial territory.
A map is fundamentally not the territory. Possessing 6 distinct lenses does not automatically endow an investor with the cognitive capacity or the systematic framework to look through all of them simultaneously without descending into complete analytical paralysis.
That is precisely why the architecture of integration is required. It is not about looking at 6 conflicting signals and guessing which one is correct on any given day. It is about actively layering them to force conflict.
Well, to understand this structurally, we must examine a specific historical trade that perfectly demonstrates how integrating these compartmentalized layers generates asymmetric returns. Let us look at the year 2005.
I want to frame the actions of Michael Burry, the hedge fund manager famous for The Big Short, because the execution plays out exactly like a heist movie. But the critical distinction here is that Burry was not a prophet. He possessed no inside information.
Right, he did not have access to a secret satellite feed or a proprietary algorithm. He was looking at the exact same publicly available data that every single major institution on Wall Street was looking at.
I know where you are going with this. Wall Street compartmentalized the data, while Burry executed a masterclass in layered integration. Let us break down the heist mechanics layer by layer.
First, he analyzed the fundamental valuation layer. He looked at the actual cash flows generated by the subprime mortgages and realized they mathematically could not justify the premium prices being paid for the synthetic mortgage-backed securities. The foundational gravity of the market was flashing a massive warning sign.
Second, he evaluated the narrative layer. He observed the overwhelming, unchallenged consensus that national housing prices never fall. He recognized that this specific narrative had become so deeply entrenched that it was literally dictating the mathematical pricing models of the rating agencies themselves.
Third, He analyzed the structural component. Wall Street fundamentally believed in the mirage of factor diversification, assuming local defaults would remain contained to their specific geographic regions.
But Burry saw the geometric fragility in the system. He understood that because these bonds were deeply leveraged and interconnected through credit default swaps, local defaults would inevitably cascade into a systemic global failure.
Finally, he evaluated the Shannon entropy of the environment. Wall Street had entirely stopped processing complex information. The entire institutional apparatus was relying on extremely low entropy inputs.
They were simply skimming the headline ratings provided by Moody's and Standard & Poor's. Burry, in stark contrast, expanded his information processing. He manually dug into 6 or more layers of loan-level data.
He reviewed individual borrower credit scores, the prevalence of adjustable-rate mortgages, and geographic concentration down to the zip code. He observed the reality that the market had compressed its information gathering, and he ruthlessly exploited that institutional laziness.
The scoreboard outcome of that integration is legendary. From 2007 to 2009, while the S&P 500 index fell 57%, utterly devastating the portfolios of investors relying on single-tool metrics, Burry's fund returned nearly 500%.
He synthesized the fundamental disconnect, the narrative delusion, the structural fragility, and the low entropy environment to execute a perfect strike against the compartmentalized thinking of the financial establishment.
Well, that is the polished Hollywood version of the story, and the final returns certainly justify the legend. But Burry's a statistical anomaly. You cannot build a reliable daily architecture based on a man who is willing to bleed capital for 3 years.
We must inject a severe dose of reality into this framework. You present integration as a clean, clinical victory. But the reality of Burry's trade is that it was a psychologically and financially agonizing ordeal.
He had to suffer years of excruciating drawdowns. He faced outright revolt from his own investors who threatened to pull their capital and sued him because he was deeply, painfully early.
This exposes the harsh limitation of your integrated architecture. Layering these 6 traditions will expertly tell you what is fundamentally broken in the system. It will identify the structural rot with incredible diagnostic precision.
But it is agonizingly, punishingly bad at telling you when the dam will actually burst. Integration provides structural awareness, but it does not solve the timing deficit. The market can remain in a state of high entropy delusion far longer than your investors' patience or your own sanity will permit.
I concede that timing and a rational market is the ultimate crucible, but I will counter that integration is the only mechanism that actually allows you to confidently hold a position through that specific volatility without capitulating.
To prove this, we must examine the perfect modern test case. I want to draw a vivid contrast between 2 companies that experienced near-identical surface phenomena but possessed completely divergent internal mechanics. Let us look at NVIDIA in 2024 versus Peloton in 2021.
The visual charts of these 2 assets at their respective peaks look entirely indistinguishable.
Both stocks exhibited the exact same parabolic surface geometry. Both experienced explosive, unprecedented price acceleration that defied historical norms. Both were surrounded by intense, globally pervasive narratives that their respective technologies were fundamentally altering the future of human existence.
Both attracted legions of devoted, unshakable believers. So why did one asset hold its value and continue to perform while the other suffered complete structural collapse?
We must begin with the consensus collapse of Peloton. As we established earlier, it lost 96% of its value. If we apply the integrated framework to the specific metrics, we see exactly why the geometric fragility proved fatal.
The narrative that COVID had permanently changed fitness behavior completely compressed the information environment. Wall Street analysts stopped analyzing the churn rates. They ignored the aggressively increasing customer acquisition costs. They stopped looking at the cost of shipping heavy metal bikes across the ocean.
When the world began to reopen, the fundamental realities reasserted themselves. Revenue growth rapidly decelerated, and the profit margins broke down. But the sheer strength of the narrative masked this underlying deterioration for months.
When we look at the scoreboard for Peloton, the fundamental layer was screaming danger. The hidden Markov regime was clearly transitioning from pandemic lockdowns to economic reopening, signaling a massive structural shift in consumer behavior.
And the Shannon entropy was dangerously low due to the monolithic narrative. The maturity of the underlying business simply could not support the parabolic valuation. The surface geometry was a bubble, and the integrated layers confirmed it was hollow.
Now contrast that internal hollowness with the sustainable surge of NVIDIA. Between January 2023 and January 2024, NVIDIA was up over 400%.
If a single tool momentum trader or a rigid value investor looked at that chart, they would immediately classify it as a dangerous bubble, citing the geometric fragility and the extreme valuation multiple.
But when we apply the integration test, NVIDIA passes across every single layer. The underlying fundamentals were violently robust. The demand from hyperscale data centers for AI processing chips was not theoretical. It was translating into unprecedented, verifiable free cash flow. Their gross margins were actively expanding, not contracting under pressure.
Crucially, the narrative environment surrounding NVIDIA was radically different from Peloton. While the enthusiasm for artificial intelligence was intense, the narrative was absolutely not monolithic.
Institutional investors were actively debating the threat of custom silicon from competitors like AMD and internal projects at Google. They were modeling the potential exhaustion of data center capital expenditure budgets. They were intensely scrutinizing the sustainability of those profit margins.
That active debate is the defining variable. Because there was skepticism, because there were active short sellers and institutional doubts, the Shannon entropy remained high. The information environment was diverse and robust.
The market was actively processing complex, conflicting signals rather than blindly repeating a mantra. Therefore, when we run the scoreboard for NVIDIA, the outcome is entirely opposite to Peloton.
The fundamentals were correct and accelerating. The momentum was correct and justified by the capital inflows. The sentiment was strong but not blinding. The statistical regime was firmly in a persistent tech expansion state.
ME entropy was high enough to ensure structural liquidity. All 5 layers were correct. The visual charts of Peloton and NVIDIA looked mathematically identical at a specific point in time, but the internal integration revealed that one was a psychological mirage and the other was a fundamental juggernaut.
I will grant that the NVIDIA versus Peloton analysis elegantly demonstrates the power of your framework when dealing with endogenous market variables, risks, and data that emerge from within the financial system itself. But I'm going to take the lead here to profoundly humble this analytical architecture.
Go ahead.
I want to present a scenario where even the most flawless, rigorous integration of your 6 layers provides absolutely no protection. We must look at the European natural gas markets in the year 2022.
The exogenous shock?
Precisely. Let us examine the mechanics of the TTF pricing hub, which is the benchmark for European gas. For years, the European gas market was the absolute picture of statistical stability. Prices consistently hovered between 20 and 30 euros per megawatt hour.
If you applied your sophisticated framework in late 2021, the fundamentals of supply and demand appeared perfectly balanced. The pipelines were flowing.
The statistical regime models processed years of low volatility data and mathematically confirmed a deeply entrenched, low entropy environment where surprises were highly improbable. The factor decomposition showed stable, predictable correlations between energy prices, seasonal weather patterns, and broader economic output.
Your integrated dashboard would have signaled a perfectly healthy, highly functional market.
Until February 2022.
Until February 2022, when Russia invaded Ukraine. In a matter of weeks, the price of European natural gas exploded from 80 euros per megawatt hour to over 300 euros.
It was a violent, catastrophic repricing that obliterated risk models and bankrupted energy trading firms across the continent. My argument is that no financial model, no matter how beautifully integrated, no matter how deeply layered your hierarchy of overrides is, can predict an exogenous geopolitical shock of that magnitude.
The models were completely blinded because the disruption originated entirely outside the closed system of financial data.
Furthermore, I would argue that relying on your framework actually created a fatal false sense of security.
The prolonged low-entropy regime was not a sign of operational edge. It was a glaring warning sign that absolute stability had bred severe structural fragility.
This is the exact mechanism described in Hyman Minsky's 1986 financial instability hypothesis. Decades of predictable, cheap energy led European economies to dismantle alternative infrastructure, shut down nuclear plants, and over-leverage their dependence on a single pipeline system.
The very stability your models measured was the exact fuel that made the subsequent explosion so devastating.
I can see that limitation entirely. It is the defining vulnerability of quantitative finance. The honest intellectual response is not to stubbornly pretend that the integration framework is omniscient. It is a fundamental truth that mathematical models cannot predict black swan geopolitical events.
However, the true value of the architecture is how it instructs you to systematically interpret that exact stability. We do not use integration to predict the unpredictable. We use integration to rigorously measure whether apparent stability is genuine resilience or whether it is a trap.
In the case of European gas, a truly strict application of the Shannon Entropy layer would have identified that the absolute lack of volatility, combined with a singular point of geopolitical dependency, represented a dangerously compressed information environment.
The framework does not tell you that a war will start tomorrow. It tells you that if any disruption occurs, for any reason, the geometric fragility of the heavily leveraged system guarantees a parabolic and destructive response.
That is a fair concession, but we must acknowledge the human element. It requires an almost superhuman level of discipline for a portfolio manager to step away from a market that has generated consistent, easy returns for a decade simply because their entropy metric reads too low.
Which is precisely why we must strip away the human emotion and rely entirely on the concrete mechanics of the intellectual architecture. How do we actually process this massive volume of conflicting data across global markets without succumbing to bias?
In practice, we run this analysis across 3 major markets: the United States, Hong Kong, and China A-shares. For every single security within those markets, we process over 85 distinct data fields.
Crucially, 43 of these fields are purely deterministic, hard mathematical outputs regarding historical volatility, moving average crossovers, and trailing cash flow yields. The remaining 17 are judgmental fields that actively quantify narrative intensity, regulatory risk, and regime stability.
But as we have established throughout this discussion, simply possessing 85 data fields is entirely useless if you just average them together. Averaging a profound structural flaw with a strong momentum signal just dilutes the warning until it is invisible.
You never average the tools. You layer them with strict, mathematically binding override power. This is the crescendo of the methodology. This is the hierarchy of overrides.
Level 1, the absolute highest authority in the framework, is information quality, or Shannon Entropy. This layer governs the fundamental reliability of everything beneath it. If the entropy is severely compressed, if the entire market believes the exact same narrative and the data sources are monolithic, the framework dictates an immediate halt.
It does not matter if the valuation is historically cheap. It does not matter if the momentum is perfect. If the market is not processing diverse information, you step away. Level 1 overrides everything.
Level 2 is structural fragility. Here, we analyze the geometric dynamics. If a price chart has gone completely parabolic and the asset requires an unsustainable geometric influx of capital to avoid collapse, this layer forces a mechanical exit.
It completely overrides fundamental valuation. The company might have an incredible balance sheet and brilliant management, but if the mathematical structure of the price trajectory is broken, you cannot hold the asset safely.
Level 3 is the composite integration. If an asset passes the entropy test and it survives the fragility test, we synthesize the remaining fundamental, momentum, and regime factors into a composite score on a 100-point scale.
This dictates precise position sizing. A score of 80 or above is a strong buy. A score below 35 is an avoid.
Finally, level 4 is the lowest tier. These are the individual tools themselves. A fundamental discounted cash flow model or a moving average crossover provides specific, isolated signals, but they possess absolutely zero independent override power. They exist only to feed data into the higher layers.
That architecture is rigorous, but it brings us back to the ultimate question that must precede every single analysis you conduct. Before you look at the 85 data fields, before you evaluate the geometric trajectory or calculate the fundamental yield, you must look at the macro environment and ask one specific thing.
Is the market processing enough diverse, high-quality information for my analytical models to actually matter?
If the market is operating in a state of reflexive delusion, if the narrative has entirely eclipsed reality, the answer is no. And if the answer is no, you do not play the game.
To synthesize the journey we have taken today, the overarching lesson of financial history, from the catastrophic collapse of Cisco in 2000 through the prescient structural integration of Michael Burry in 2008 to the divergent fates of Peloton and NVIDIA, is that the problem plaguing intelligent investors is never the absence of analytical tools.
The industry possesses more than enough tools. The fatal flaw is the absence of integration. By deploying a strict hierarchy of overrides, we force our models to cover each other's blind spots.
We ensure that we never mistake a compelling narrative for fundamental gravity, and we never mistake apparent statistical stability for structural resilience.
We must always remind ourselves of the humbling reality exposed by the European gas markets. While your hierarchy of overrides is an incredibly powerful mechanism for navigating endogenous market risks, the world remains irreducibly chaotic.
The market will perpetually retain the capacity to blindside us with exogenous shocks that exist entirely outside the boundaries of our data fields. Integration is a magnificent survival suit, but it is not, and never will be, a crystal ball.
Evaluating how these layers overlap and interact reveals entirely new dimensions of market mechanics. Looking closely at the precise friction between gravity and fuel provides a deeper, more resilient way to evaluate the complexities we will continue to explore in future series.
This is the Research Desk officially signing off.